Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hi, everyone. Welcome to the Small Cap Discoveries conference call. Today in our call, we have CEO Alex Baluta from Flow Capital. Flow Capital trades on the TSX Venture under the symbol FW and on the OTC under AHFCF. The company is trading at 51 cents with roughly 31 million shares outstanding, or about a $16 million market cap. I'd now like to hand it over to Paul Andriola.
Hey, thanks a lot, Trevor. Yeah, great to have Alex back. I mean, we spoke, Alex, a little while ago, but this will be the first time in front of our audience. So great to have you here. Flow Capital is a name that we haven't really spoken about much in sort of in our community, but I thought it'd be a great idea to get some exposure to the name. So Alex, why don't you tell us what you guys are all about, and then I understand you've got a presentation, so I'm just going to turn it over to you and let you have at it.
Great. Thank you, Paul. Thank you both, Paul and Trevor, for giving us this opportunity, and hopefully you can see my screen.
Sure can, yeah.
Thanks to everybody else, both live and who's going to listen later. I appreciate your time, and here to tell you about Flow Capital. We are a company that finances high growth venture level opportunities, the kind of companies that are the cornerstone of the modern economy. Let's make sure I can adjust my screen here. Here we go. Typical disclaimer, we are a public company. Everything in this presentation is fully publicly disclosed. The presentation is current as of the end of Q2, which is a June quarter end. We're reporting our Q3 in about 3 or 4 weeks. So I'm going to talk about 3 things today. Why invest in Flow, which is really about our business model and the opportunity that we face. 2, why now, which is always important for investors. And 3, how can you invest in Flow? And we really have 2 structures. One is our common shares, and one is a securitization vehicle called the Priority Return Fund. I'll go through those in details. So here's a summary. If you only watch for 5 minutes, I'm going to summarize it here for you. 1, the opportunity, we provide you a diversified way, low risk, diversified way to get exposure to the high growth businesses powering the modern economy. Think of it as we give you a diversified venture capital like portfolio with debt like security and cash flow. And we have our own recurring business model that we use to make those investments. Why now? We're cash flow positive, trading at below book value. We've surpassed our fixed cost operating leverage sort of inflection point. We have a fantastic pipeline. I was talking to Paul before we started recording. The amount of deals that we're seeing of ultra high growth, very, very strong, well-funded companies is quite surprising. I think there's, post-COVID, there's a remarkable environment. Our own growth, we ourselves are a growth company. Our internal goals are 100 million in assets, 15 million in revenue, and 8 million plus in free cash flow before the end of 2023. And given the traction we have, I suspect that we'll get there earlier. And a couple of bonus items. This is very important, is that we, on average, own about 2% of most of the companies we invest in through warrants. It represents significant equity upside in our portfolio that really is hard to price in. But when you're investing in high growth companies, that equity opportunity is significant. 2, we've been bringing down our cost of capital significantly. We continue to do so. And we have over 40 million in tax losses to shelter future income. So we're well positioned to provide strong upside to both our stock for investors. So let's talk a little bit about our business model. Why invest in Flow? What is it that we do? So as I mentioned, we provide you the opportunity to invest in venture capital type deals that you wouldn't otherwise have. So we provide you access to, currently our portfolio is 16 type investments. So we provide that diversified portfolio, normally accessible only to venture investors, with lower risk and more liquidity than you get in a venture environment or venture investment, with higher income and higher upside than you would in banks. So SaaS, e-commerce, AI, machine learning, et cetera. Those are the kind of companies that are in our portfolio. And just so you know, we've been doing this for quite some time. We've deployed over $120 million in capital in our history, 56 deals in aggregate, 16 are currently active. And we have 13 warrant positions and 4 common equity positions. And we ourselves have developed a repeatable business model for generating recurring revenues. And as you'll see later on, we only take secured debt positions in the companies that we invest in. Just a quick snapshot. I'm not going to spend time on this slide, but you can pause here if you'd like. Some of the companies in our portfolio, the majority of our portfolio, especially after our last investment, we just put $5 million into a fantastic company called Everwash. Over 80% of our portfolio is tech or tech enabled. Very little is outside of tech. And then we have some warrant positions in tech companies from prior investments that we've exited. So if you had to take one word about what we focus on, what do we look at in companies? And we do extensive due diligence. It's all about growth. We love investing in growth because growth itself reduces risk, primarily because companies are more fundable. But first of all, growth provides more downside protection. On average, the companies we invest in, we represent a very small percentage of the total enterprise value of the company. So 5, 10, maybe 20%. So there's 80% of the equity values below us. And that equity value increases disproportionately faster in high growth companies. So that's key for us. 2, that growth gives you more exit alternatives. Of the 5 exits that we've had this year, 1 was through equity. The rest were through lower costs of capital. As the companies continue to grow, they become more attractive to either to an additional venture round or to bank debt. And then those warrant positions provide us with additional upside for our shareholders. So that's why we love investing in growth. Just a bit about the team. I've been doing this for almost 30 years, both on the buy side and sell side. I started my research career with a small company called Marlowe Lemire Securities way back in the day. I then was at Midland Malman Merrill Lynch here in Canada, and I ended my research career. I was #1 equity analyst in Canada in technology software. I then ended my career in the US with Robertson Stephens, did some time on the sales desk, some time in investment banking, and then for the last several years on the buy side. And I've been here at Flow for just under 3 years. Really, the core of my experience is all about diligencing and investing in high growth companies, primarily in the tech space. The rest of the team, my CFO in particular, everybody has experience commensurate for the position that they hold in the company. It's all about small cap investing and loss minimization through credit type investing. So Josh recently joined us from Crown Capital. Randbor was doing the same thing at a hedge fund. Aaron is actually a private banker, and he's helping us develop deeper and deeper relationships with venture capital companies. And Matthew's got 7 years experience on the sell side as well. One of the things that I'm very proud of is the board. We have a phenomenal board for a company of our size. You might recognize some of these names. Vernon, our executive chair, very active in the business, 2-time successful venture capitalist here in Canada. Gordon McMillan, one of the founders of Converge Technology, a big name on the TSX today, has gone from a $1 to $12. Alan Torrey took Morneau Chappelle to a $2 billion company. Michael Zich, former head of global fixed income at Scotiabank, and Catherine McLeod-Seltzer, the independent chair on Kinross, and a very well-known name in the mining sector. Very high-powered board, and I do appreciate working for these kind of people because they really add a lot of value, and they keep us focused on generating shareholder value. So let me summarize our business model as follows. We generate recurring revenue from debt investments that are first in high growth companies, as I've already mentioned, with a proven value proposition, meaning they have to be generating revenue. We don't do early stage things. In that gap that exists between banks and VCs, and in fact, sometimes we partner with VCs to help extend their existing round. We're secured in top of the capital stack, so we're a debt investment. We try to do the appropriate risk return profile, meaning debt-like risk and equity-like returns. We do it with equity upside in our warrants, and we do it in a scalable and repeatable way. That is our business model on a slide in a nutshell. And we like to say for companies that have nailed their value proposition, we help them scale their business. And just people are going to ask, what's the addressable market? The venture debt market, which is the market that we play in, there's over $40 billion in venture loans outstanding at any given time in North America. And in any given year, there's over $10 billion in origination just in North America alone. It is a well-defined In fact, it's quite a growth market when you look at the VC segment overall. Venture debt is the growth segment of VC. We invest with primarily, really, it's a debt structure, but they can have three flavors. It can be an amortizing term loan. It can be a royalty-linked loan, which is more of a, think of it as a perpetual loan that is repayable at the company's option. And 90+% of our term sheets are venture debt bullet loans, i.e. non-amortizing term loans, on average 3-year term, 15% interest with warrant upside. Now, you might ask, why would people pay 15% interest? The reason is, for a high growth company of the type that we focus on, their cost of capital for a venture investment is dramatically higher than 15%. If their revenue is growing at faster than the cost of our capital, so anything above 15%, they should always take our money, because we postpone dilutive equity rounds for them, and it is a much better value proposition for the owner of that high growth company than it is to either do a dilutive, well, primarily to do a dilutive equity round. Our process is quite intense. We do 3 to 6 weeks of intense due diligence. The time frame is really depending on how ready the company is with their materials. But this isn't sort of a one management call and done. This is a very in-depth process. Just to give you an example of why we like growth and the positioning of our portfolio, the slide's getting a bit out of date, but this is the organic revenue growth of our portfolio through COVID. So through COVID, our portfolio companies generated over 50% annual revenue growth on a year-over-year basis. In other words, it was the companies that were positioned well through COVID to grow, and they continue to grow at this pace. Let me give you a couple of specific examples. Portfolio company A, company based out of the UK, our first UK investment, phenomenal company. They did a seed investment equity round here. About 4 years later, they came to us. This chart, by the way, represents their monthly recurring revenue. It's a SaaS company. At about 200 per month in recurring revenue, 2.4 million in aggregate revenue. We put $1 million US in there. Between these two rounds, they got a couple of equity term sheets, valuations of between $50 and $80 million. They didn't like the terms. They came back to us. We gave them an additional second round of $2 million. We now have $3 million invested in a company doing over approaching 400,000 in monthly revenue on a SaaS basis. And this is a very, very buttoned down management team. They still have more than $3 million on their balance sheet, which is what we have invested in them. And we own 2% of this company through our warrant positions, or our warrants in this company. That's an example of the typical type of investment we look at. We look for experts at growth and at operations. Portfolio company B actually was a recent exit. It's called Stability Healthcare. We put in a first tranche, then a second tranche, and then these guys were in the nurse staffing business. And obviously through COVID, that was particularly good for them. And they refinanced us with lower cost of capital after their revenues were up 9x and 10x through COVID. So these are the types of companies we look for. The growth profiles may be a little bit different, but it's always about growth. And we always own roughly 2%. But the nature of the size of the deals that we're doing and the timing of the companies, it always ends up being somewhere between 0.5% and 4% in equity that we own through warrants. Here's a final case study, Factor 75. It is a pre-processed food delivery, meal delivery company. They did a venture round, a seed round, I should say. We then put in 2 tranches of $375,000 each. It continued to grow. That allowed them to postpone their Series A. When they did their Series A, they used the proceeds from that to buy us out. And then after Series B, this company was acquired for $277 million Canadian. So in less than 4 years from the date of our first investment, they exited at 277. And what you'll see, this was actually not a company we owned warrants in. This was a royalty. And in our royalties, at least our historical royalties, we had bio premiums as opposed to warrants. And this was the revenue we generated through this investment. So in aggregate, we made a $2.71 million return on a $750,000 investment in 32 months. And so this is the type of investment that you'll see in our portfolio. Our parameters, pretty straightforward. They got to be high growth. They got to be revenue generating, minimum of 4 million if it's non-recurring, 2.5 if it's recurring. Tech is the natural sector for us because of the growth rates, because of the cost of capital in tech. So we're a particularly good fit for asset-light companies. We do not do real estate. We do not do primary resource extraction. There's plenty of great companies out there who do that. Actually, this has gone up. Our first tranche, we just did a $5 million US first tranche $7 million in total is what we'll do in terms of exposure. Canada, US, the UK. They're always the debt structures. We do work with VCs. In fact, it's part of what the area that we're growing is more VC sponsored investments, but we're also good with bootstrapped companies, i.e. entrepreneur funded companies. But what we then focus on is independence and governance. We spend a lot of time making sure that we have the right governance in place. Profitability is not required, but either they need to show a path to break even, or we invest a very strong conviction on their ability to raise another venture round, which means very strong venture partners. As I said, we're senior secured, and then all the intangibles, high, strong management, product market fit, customer fit, partner fit. So we do a lot of customer calls as part of our due diligence. Quick snapshot of our diversification. This is as of the end of Q2. Some of the key metrics to know is we've been doing larger and larger deals. So 60% of our deals now is in 3 million or greater investments. We've been doing more loans. In fact, you'll probably see loans be the only things that we'll do going forward, although we're open to royalties. And since our last investment, we now have roughly 90% of our portfolio in loans, in 9 different investments, 8 investments in royalties. Royalties used to be a lot smaller, and they represent less than 10% of our current capital. And we're open to VC and non-VC sponsored deals. And as I said before, it's really a focus on making sure the right governance is in place. And within technology, we're well diversified across industries. So that's our business model. Why is now a good time to invest in Flow? So I got a couple of slides. Let me explain them first. This is a view of our balance sheet, a simplified view of our balance sheet on a per share basis. So above this line here, you'll see the cash in the white, our portfolio, invested portfolio in the light blue, and our equity portfolio in dark blue. Below the line is the debt that we carry in that particular quarter. Our book value is 70 cents at the end of Q2. And the blue line, that's the white line. And then the blue line represents our share price. So we continue to trade at a discount, a 26% discount to book value. And just so you're clear, that's tangible book, cash portfolio and equity portfolio only tangible book. We have 40 million in tax losses, which are not on our balance sheet at the current time. And it's very rare. You'll see on the next slide, we have positive cash flow. It's rare to see a company trading below tangible book with strong positive cash flow. In fact, our nearest competitor, also a public company, trades at over 4 times book value. So for us, it's not about book value. It's frankly, I'm pointing this out because of the discrepancy, but we are trading at significantly below book. One of the other things to point out on this slide, by the way, is that in the last 5 quarters, we've gone from 38 million shares outstanding down to 31. If you go back 2 more quarters, we had 44 million shares outstanding. We're down at 31. And to be honest, that was us using our capital to buy dollars with 50 cents. Right? Or in other words, we were buying back our own shares because we strongly believed in our value proposition and the value that would generate for shareholders. This slide represents the income side of our business model. This is our income statement on a quarterly basis. Now, the white line represents revenue from recurring operations only. I will warn you that if you look at our financial statements as per IFRS, they're all over the map. There's revaluations that hit revenue, et cetera. So let's boil it down to interest only. This is what we see on this chart. Below the line, you see OpEx and you see interest expense. So that's what that represents. The dark green is our EBITDA that we generated in the quarter, and the light green is our free cash flow. So you'll see 1, 2, 3, 4, 5. We've had 5 quarters of of positive free cash flow growth. And then you'll see this light green box. That represents a cash gain over and above the value of that asset on our balance sheet. So in this case, we had an asset on our balance sheet that was valued at 0. We're quite conservative with our valuations. It was a longer term past investment. They did an RTO, paid us $1.5 million cash. It was $1.5 million cash gain that was prior to getting that cash was at 0 on our balance sheet. And so what you'll see over time, not so much through legacy investments, but through our warrant portfolio, is we have 13 warrant positions now. That'll go to 20, then 30 as we grow our portfolio. It's hard to forecast, but you will see cash gains through our portfolio because high growth companies usually get either through an IPO or through an M&A. We can't forecast them, but they will hit our cash flow and increase our book value. And then ultimately our target by the time 2023 rolls around, we want to have 100 million in assets. That should generate 15 million in revenue, $7-8 million in free cash flow, and well over $10 million in EBITDA. Put any multiple you want on that, and our stock is significantly undervalued. We're here today. We're over $30 million invested assets, over 44 million, or about 44 million in total assets, and only 2 million of that is in our equity portfolio. That being primarily in our warrants. So quick financial summary snapshot. I've talked about most of these numbers: 44 million in assets, $22 million in book value, or 70 cents a share. Annualized revenue run rate is 6.5. We had a lot of exits, and we've redeployed that capital. So Q3 might be a little lighter than that because of the redeployment. So when we have an exit, a successful exit, we then have to redeploy, and 500,000 in free cash flow in the last quarter. A couple of key points to mention though. Management ownership on a basic basis, that's management and board. We own 20%, roughly 20% of the equity on a basic basis, and about 30% fully diluted. So we are meaningful shareholders in the growth of the company, and we look at it as every dollar we invest, 30% of that is our own money. And then it's hard to show a focus on quality in a slide, but we consciously focus on 0-0 in our investment approach. 0-0 means we target 0 defaults, i.e. 0 losses. It's an aspirational goal, but a low single-digit target on defaults is what we shoot for. And any defaults we lose are made up with gains in our equity portfolio. But we've been having tremendous progress. The real lifeblood of our business, the growth of our business, is through deal sourcing. Aaron, the fellow we just hired, is about building our referral network and building our relationships with venture capitalists, investment bankers, and others. But we've been doing a tremendous amount of investment in paid digital and organic marketing, and all of our initiatives have really paid off. We're seeing much better quality deals than we've ever seen, much larger deals, and our close rates are increasing. So that's a lot about the momentum. And finally, I mentioned before, I've said it a lot, but our equity portfolio represents an undervalued asset. We continue to bring down our cost of capital, and we have lots of tax losses to shelter future income. So how can you invest in Flow? Well, first, there's the equity. The equity, we do not pay a dividend. There's no plan on paying a dividend for the current time. But all the torque and the upside accrues to our equity holders. We do also have a securitization vehicle, an LP called a Priority Return Fund. And what it does is we only roll in existing assets into the fund, never has any undeployed capital, and we pay a 9.25% yield. We're only taking US dollars right now, and that's to match the nature of our portfolio, which is mostly US dollars. But it pays a 9.25% preferred yield. I'm going to go through the preferred fund just because I want to give you an example of how it works. What's important about the Priority Return Fund is that for every dollar we take in 80 cents of preferred capital that pays 9.25, and Flow subscribes to 20 cents of subordinated capital, or 20% of the total value of the fund. And that provides our preferred unit investors significant downside protection. And those preferred units, let me just say a pause there for a second. We're raising $6 million right now in the preferred units. We've got about 17 million outstanding in the fund. Post this raise, it'll be about 24, 25. And as I said, Flow subscribes to those subordinated units. What's important about the preferred subordinated aspect is that if you think a traditional LP, usually management doesn't invest or co-invest. They certainly don't provide subordinated units. We do, and the preferred units take first priority on all the interest payments, which right now we're at 2.6% interest coverage, and they take first priority on all maturities in the fund. So it's a bit of a self-liquidating structure where, assume we have a $10 million portfolio and we have a $3 million maturity, that all that $3 million is paid to the preferred unit holders, not pro rata preferred and subordinated, but all to the preferred. And what that does over time is that raises the amount of preferred units relative to the number of, the number of subordinated units relative to the number of preferred units. We have two types of units, 9.25, which is basically a G, or an 8.25 for a broker if the broker takes a trailer, or we'll pay the broker a 1% trailer. The current Priority Return Fund has 8 investments. We're about to roll in another. The total revenue out of those companies is over $133 million. The buyout at maturity value of those loans is $24.7 million. And the interest that we're earning on these investments is over $4.2 million, where that is 2.6 times larger than the amount of interest that we would pay to the preferred unit holders in that fund. And I mentioned 2.6 times interest coverage, and buyout repayment coverage from our subordinated units gives the preferred units a 1.2x coverage. And I'm going to mention one last point about the alignment here. So not only do we own 20% of the common shares on a basic and 30% fully diluted, management and board and insiders own about 1.1 million in preferred units of the priority return fund. The whole point is that we're aligned with you. We're fully invested alongside of our shareholders and our unit holders. And the reason is because we believe in the upside of the company. And so again, just to reiterate, our 2023 goals, 100 million in assets, 15 million in revenue, 8 million in free cash flow. I'm going to pause there, Paul, and see if there's any questions.
Perfect, thanks. Guys, anybody listening, if you have any questions that you want me to ask Alex, use the chat function, the button at the bottom, and we can go ahead and do that. Alex, I think you've done a great job in presenting, so the questions are pretty thin here. But why don't we talk a little bit about just sort of the competitive landscape when you go up against others that are providing loans to this type of company or these type of companies. Who are these typically that you're competing with, and are there other players out there, trying to do the same thing?
Yeah, absolutely. It's in a $10 billion a year in origination, lots of players. So start with CIBC as an example is in this, where they bought Wellington Financial. Wellington did venture debt. CIBC, that's the anchor of their innovation banking group. RBC just now announced RBCX. Those guys are competing against a group called Silicon Valley Bank, SVB. Those are deals at 50 million at a time. That's the high end of the marketplace. In the middle of the marketplace, there's a number of players. In Canada, there's a number of private players. Espresso Capital is one of them. Vistara Capital is another. There's a US competitor that we compete against occasionally. See, it's called Lighter Capital. I will say that Vistara and Espresso are a little bit upmarket from us. They do 10, 15, $20 million deployments. We do $3 to $7 million deployments. And so you'll see this market stratifies based on size of deal that you do and type of deal that you do. Some will only do SaaS. Lighter Capital in the US only does SaaS. Tamaya Capital, which is a publicly traded player here in Canada, it's a comparable to us. They're the ones that are trading at 4 or 5 times book value. They do similar deals to us, a little bit smaller, similar in size. So there's lots of players. The reality though is that we almost never see the same competitors in each deal. So I may see Tamaya in one deal. I may see Lighter in another deal. In fact, one of the deals that we just closed was a deal Lighter tops out at about $1.5 million. So we now have more of a strategic relationship with Lighter, where when their companies outgrow them, but they don't want to do a venture round, they then come to us. And so there's actually more. Firepower is another one here in Canada, private company. There's more cooperation, surprisingly, than there is competition. I'll see most of our deals, there's no other term sheet, or at least none that we know of. If we do see it's one of the regular competitors, and it might have been some term that they liked better on the other term sheet than ours. So to use a not so great analogy, it's a bit of a teacup in a tsunami. We're just trying to scoop a teacup of deals with just so many deals coming over the transom. And look, we close on our prior slide. We close on less than 1% of our deals. That's a function as I tell my board, the more great deals I can see, the better. And so we're actually trying to increase our deal flow so that we can see even better deals, so that we can invest in the 9.9s out of 10 instead of the 9.5s or the 8.5s, right? So it's a big market with lots of opportunity, but we rarely see the same player twice.
And how do you do that to go out and try to find more deals? I mean, you've added some people that are out there sourcing deals, but I just imagine you're drinking through a fire hose right here, as far as how many deals are out there. But how do you really go and source them and then do your due diligence on so many deals?
I'll go back to that slide I had a couple of slides ago. So this is an industry average where deals normally are sourced from. And call this industry average column. 45% were from referral networks, and that can kind of be broken down into your personal network that you've developed over time. And with me being on the street for almost 30 years, lots of relationships there. Similarly with our board and their relationships. But also, once you build a relationship with an investment banker or an accountant or a lawyer or a venture capitalist, and they get comfortable with your approach, they then call you. I'll give you an example. We had a deal that was referred to us. It was a little too large. It was from a senior bank. They went with a different player. That player wasn't playing ball well enough. That bank came back to us and said, "Are you sure you can't look at this deal?" In other words, it's also about building good relationships and being a good partner to those other referral networks. So number one source is referral networks. But what you see here, what we've been doing is we've really focused on our digital efforts. And let's face it, the vast majority of our deals have been and will be technology. The young entrepreneurs that we're seeking, they're more digital than ever. In the ability to source deals through digital, we focus on our content. If you go to our website, we have a tremendous amount of content for the entrepreneurs describing what venture capital is, what venture debt is, what alternate sources are. We do training courses. We help out other partners. So those three sources of referral networks and digital efforts are where we get the majority of our deals. And we've just hired an additional person to help us focus more on digital referrals. And I think the truth is I can never see too many deals. It's easy to weed out a deal. And we want to see the absolute best deals that we can. So if we're going to build anywhere, it's on our sourcing network.
And the other part of deals are what really do you guys do when things go wrong? How do you monitor your deals, and what ultimately do you try to do to save what you can from a loan that goes bad?
So it gets back to one of the reasons I love the space we're in is because of the value of that growth is disproportionately larger, right? Or I should say of that equity value below us as the companies grow. I'll be honest, it's pretty easy to sell a software company doing $4 million in ARR, almost regardless of the market. The M&A market is pretty substantial for those kind of companies. But more importantly, though, that's how do you have to exit? And when I'm top of the stack, I'm well positioned. But what we do, we have a fairly hefty requirement of reporting. So every month they send us the trial balances, the financial statements. We have a tool that we use called iLevel that tracks their performance on a monthly basis against both historical and against their own forecasts. And when we see a problem, we proactively look at our portfolio regularly. We call our companies and say, look, you're on the wrong path. You're not making your numbers. 6 months from now, you're going to run out of cash. Let's make sure you don't get there so that we're not in a difficult situation having difficult conversations. So one, we try to minimize our deals. Deal selection is important. High quality companies, great opportunity. Two, we monitor our portfolio. We react quickly when we see problems. We cooperate with our companies to try and minimize any kind of downside situations. But if it gets there, we're well positioned being senior top of stack in what is usually a tech company that's fairly reasonably would have a decent market value. So it's about that last one is the last resort, forcing a sale, but that is available to us if we need to do it.
And we talked about a little bit before we got on air here. We talked about some of the challenges some of your sort of portfolio companies face as far as staffing. But what do you guys face? What are your challenges as a growing business in this landscape?
It's a good question. Deal flow is that's, as I've said before to my board, are the superpower that we need to build is deal flow. And I think we've done a really, really good job of that over the last 3 years. The second superpower I need to build is capital sourcing. The priority return fund is a great structure, but we want to grow this company not just to 100 million in assets, but 500 million in assets and $1 billion in assets. There are venture debt players out there that are well over $1 billion in assets. And the average returns in venture debt are actually very low variability and high returns. What we don't do is venture debt doesn't have those huge 10x portfolios that you'll get by investing in a Kleiner Perkins and then all the others, so it's got a big barbell of a lot of losers at each end. Venture debt is much narrower. But there's a big opportunity to continue to grow this. Like there's no limit to how far we can grow. So the two challenges I have are deal flow, which we're working on, and capital access.
Gotcha. You get roughly a $15 million market cap company right now. What are you doing to get yourself a little more exposure? And give me a sense, outside of the 20 to 30% management ownership right now, who else sort of makes up your shareholder base, do you think?
So two questions. The easy one, how many do we have? We have about 450 shareholders.
Mm-hmm.
The company itself had been the product of a consolidation for a couple of M&As, and we had 3,500 shareholders with 1 share, 2 shares, 3 shares. We consolidated that down to a small, reasonable, tightly held share base. But to be honest, I've just started getting out to tell the story. When we chatted a few months ago, that was probably one of the first times I gave the pitch. I'm only now going out. I had a pitch to a independent on Tuesday. I'm starting to talk to banks to get access to the bank shelves, and it's really about me getting out and telling the story. It's probably going to be 50% of my time for the next 6 months. So we've been under the radar. We haven't really been saying anything, and now my board's giving me the marching orders to go out and tell the story. And I think that we really feel that we have the business in a position where we're very excited to tell that story.
I'm going to take a little bit of a tangent and ask you a question. You're an investor. Clearly, you see a lot of investments, and a experienced tech analyst. But as a smaller investor, what do you think the small investor gets wrong when he looks at technology investments?
They believe the hype. I think okay. So I'm speaking through my 30-year lens on technology investing, and I have seen hundreds and hundreds and hundreds of business models or business plans or pitch decks of the next greatest thing, and they never go anywhere. Real revenue, so I talk to my companies as an example about what kind of technical due diligence do I do? The answer is I don't care what technology stack you're built on. I call your customers. If your customers love your product and are willing to talk in glowing terms about your service and how they save you money or you save them money, etc., then I know your technology is going to be well built. There's always room to continue to build your technology. What I think people get enamored with in the small cap space is, I'm going to invest in this and it's going to be the next Facebook. Maybe. I know one guy who invested in an early stage Bitcoin type product and did very well, but that's it. I know one guy. So I think that the problem with small cap investing in technology, particularly on some of the smaller exchanges, is that it's really hard to get to know. A typical investor can't do the due diligence to make those customer calls the way that we do. And with Vernon and myself and some of the other members on our teams, I am not exaggerating when I say I have seen hundreds, if not thousands of companies and thousands more presentations. And you get to, it's what we offer is that diversification of, look, we've got the experience, we've done this for years, we're trying to pick the best companies, we're doing the best we can, we're aligned with you, and we're giving you a diversified portfolio of 16 now, going to 30, going to 50 companies that takes that risk away from you so that you don't have to just pick that one great, Facebook-like name and maybe be wrong. So it's a broader answer. I just think it's hard, and I think if you're not a real in-depth technical investor or technology investor, it's really easy to be swayed by wow, that's such a great idea.
Yeah, I'm glad you sort of said it that way. I love the approach of what you guys have of being able to go after a diversified set of deals that the average investor just will not get a chance to invest in until it goes public at likely a significantly higher value than what you guys ever touched it at. So this is a pool of investment opportunities that the average person just not going to be able to touch for years and years and years.
That's right. That's exactly right.
That's awesome. I'm going to tell you, I've got one question from the audience right now, and it refers to, do you guys ever or is there a likelihood of ever investing in blockchain or DeFi deals? Do you guys look at those?
We don't have any in our portfolio. 3-4 years ago, we saw 2-3 years ago, we saw some Bitcoin mining type opportunities. There was some discussion about, but no, it's not that we don't believe in them. We just haven't seen the appropriate risk return profile. So again, companies we invest in need to be generating revenue, real revenue, sustainable, repeatable, where customers have bought into the value proposition the company offers. A miner, if it's about the lowest cost of energy, cold environments, then it's just up to the whims of the marketplace. So it's not that we wouldn't invest in that. We'd look at it. It's just that we haven't seen the right opportunity to make an investment in that space. So it's a bit, to me, it's a bit of the Wild West still. I own some digital coins myself personally, but as we have a very specific credit box that we look at. And so far, nothing has shown up that would fit into that credit box with the security that we're looking for.
Perfect. Listen, where do you see Flow Capital in say 5 years? What could this business look like down the road?
Well, in 5 years, I'll be disappointed if we don't have 300 to 500 million under management. We'll probably have a slightly lower cost of capital at that point. So instead of 15%, maybe we're making 14, but that's going to be, we'll be generating 75, 80 million in revenue. It'll be, the one thing about this business is it scales very well. We have the tools in place. What we're not, to be clear, is we're not a clear bank. We don't have digital adjudication tools. We have tools that help us a lot, digital tools that help us make decisions. But at the end of the day, it's about an investor, just like you, just like everybody on the phone. Do we like the company? Does it meet the requirements? I think that some of those companies that do digital adjudication are very, very good companies. They have to do it in a very, very narrow niche. So to answer the question, hundreds of millions under management, a strong revenue, and really strong cash flow, because we can scale our business not as quickly as some of those, but with a head count, we're at 8, 9 going, now that'll get us well over our near-term targets. And you can scale the business both through headcount, but also through larger deal sizes and diversifying into slightly different product areas. But for now, we're laser focused on the markets that we're in, and we're just going to keep doing what we're doing. That's the short answer. We're good at it.
Awesome. Listen, as the investors that are listening today, what do you think we should be watching for? What sort of key metrics or key catalysts should we watch for in your business, say, over the next 6 to 12 months?
I think the key one is honestly free cash flow. Now, you're going to see some variability. I mentioned the last quarter we had, this year we've had 5 exits. Several of them hit at the end of last quarter. And so there'll be some variability as we have exits and then redeployments. But the general trend is up. And what we're focused on is long-term sustainable cash flow generation through recurring revenues. And I will say that our compensation plan is aligned with that. We, particularly for C-level executives, we're heavily motivated by cash flow generation capabilities and share price. And so, it's a virtuous circle. I need to get the cash flow up. I need to raise equity, but minimally dilutive. I'm not going to do it at below book. And then we need to, continue to get the story. So really watch for our what you'll see in the next 12 months is a more sustainable cadence of deals as we invest in more deals. And then that will translate into better revenues, and that'll translate into more free cash flow. So that's with some variability along the way. That's how, it's up and to the right in terms of revenue and cash flow for us.
Perfect. So Alex, we're near the end here. Is there any key takeaway or key message you really want everybody to leave with today? If so, let us know. What is it?
Listen, we're aligned with shareholders. This is a fantastic market to be in. We're top of the stack. We're generating positive free cash flow. And the reason we're here today is we have just a phenomenal opportunity of growth ahead of us. Growth in our portfolio, growth in our revenue, growth in our cash flow. So we're just very excited to be here. And what hasn't kicked in yet, in all honesty, is the sort of regular cadence of returns from our equity portfolio. Because we only started taking warrants 2 years ago, 2.5 years ago. And so our 13 companies that we have warrants in now, I can't see us doing a deal without warrants. And as we do more and more deals, as we grow our asset base, that warrant portfolio swells. And as I said, we can't forecast what we're going to get out of that, but in the type of companies invest, I showed you some of those charts. We will have warrant equity exits. And as of yet, we just haven't started to see that because our warrant portfolio is too young. The average duration on our warrant portfolio is still probably 5 years.
Perfect. That was a question I was going to ask, and I hadn't, and I'm glad you brought it up. So it's perfect. Listen, this is great. It's always nice when we can sort of bring a new opportunity or a new area where investors can invest in that they really don't have access to. And it's always great to have pros kind of doing that for you. So you kind of wrap that up in a bow for us. But listen, Alex, if somebody wants more information on Flow Capital, what's the best way to get it? Maybe a website or email address?
For sure, the website. Email me directly, alex@flowcap.com. Very simply, I'll make sure I respond to me as quickly as I can. We're a small team. We're responsive. If anybody's interested in a priority return fund, give me a call. If anybody's just wants to learn more about our business, we record our conference calls. So there's a legacy of conference calls that you can go and listen to. But yeah, we'll respond. Website and me personally, that would be the best way.
That's awesome. That's great. We've been speaking to CEO Alex Baluta of Flow Capital. That's FW on the Venture Exchange. Alex, great to catch up today, and certainly look forward to catching up to you guys in the future.
Thank you, Paul and Trevor. You guys do a great job and a great service for small cap investors. Glad we could be here. Thank you.
Appreciate it. Thank you.
Cheers.